In this pod, we break down investment vehicle choice, individual stocks versus mutual funds versus ETFs. This is not one of those know nothing, just buy low cost ETFs podcast. We're digging into the real stats behind performance, taxes, and the psychological trap investors fall into. And yes, we're also exposing the nasty little secret behind why some advisors knowingly put inferior mutual funds in your account. Let's go, baby. Quick ask, if you're enjoying the show, hit the follow and drop a rating. It helps more folks find our podcast. Thanks so much. From Wall Street to managing hundreds of millions in client money, Nick and I use our alphabet soup of credentials to discuss the investing and tax strategies that actually work. Oh, and we played Division I college football together, so strap in. This one hits hard. Let's go. All right, Nick, we all know everyone loves picking individual stocks, and they've seen people come unconscionably wealthy based upon it. But I think when you start to dig into the numbers a little bit, you get an idea of how low the probability of long-term success actually is. And then we'll also dive into a little further out to touching on that data of just if you've picked a winner, then the psychological battle that enters from a taxation perspective. So we'll touch on individual stocks, and then we're going to move to mutual funds as well as ETFs. So let's start things off here. Why don't you hit them with a little data on the performance of individual stock pickers?
Yeah, let's dig in that a little bit and see how the average investor has performed buying individual stocks versus the index, the S&P 500. Going back to 2022, rough year for stocks overall, the index itself was down 19%. Unfortunately, your average investor was down 39%.
Yikes.
But Taylor, you may be wondering like, oh God, well, it was a down market. But let's take a peek and see how things go in an up market. Let's look at 2024. Index is up 25%. Individual investors, however, up 16.5%. So we have an example of an up market and a down market where individual investors significantly underperform the benchmark.
And I would have guessed in the down market that doesn't shock me. People take typically higher risk investments than the broad diversified index. And so on the downside, not that shocking. But when you talk about 2024 and what a lights out year it was, especially for the big names that everyone knows and loves in the technology space, that is shocking. So now you've got an up market and a down market where they've both underperformed. You got some data on broader numbers, outside of just 1 year synopsis?
Yeah, so let's zoom out. Over a 30-year period, the S&P 500 has averaged 10%. The average U.S. retail investor averages only 3.9%. So pretty tough numbers there over the long term as well.
Yeah, 6% disparity between the two. So why is it that everybody says, hey, I'm going to go out and buy individual stocks? This seems like a game that I can win over the long term when so clearly the casino deck is stacked against you, at least if history's any indicator.
No, that's for sure. I think there's a multitude of reasons folks are going out buying individual names. I think first and foremost, you're going online every day, TikTok, Instagram, and you're seeing folks who claim to be full-time day traders bragging about their wins. I don't know about you, but every time I go out and I'm talking personally about something I've done, I'm going to highlight the good things that happen and not the losers that I've experienced. So
I try to chop myself down to reality, give people the bad side as well. No, dude, you're so straight on. It's funny when people come to us as new potential clients and we ask them, hey, what is it you're doing from an investing perspective? They might say, hey, I'm picking individual stocks or whatever. And you ask them, my favorite part about this job is to ask them, okay, well, what is your process for deciding what individual stocks you're going to select? The outcomes are just magnificently hilarious. I should do a video on Instagram about this. Just, hey, take clips out of these videos or out of these video calls that I do with folks and just what is it they're saying? Because the most frequent answer I'm getting these days is ChatGPT. And I'll honestly say that might actually be the best answer I get relative to a lot of the other ones. But I even tell people like ChatGPT is there answering questions to the best of its ability, but it's also there to try to make you happy as well. It's trying to give you the answers you want to hear. Is individual stock selecting a good thing? Well, if you're a skilled investor, this and that, probably it is. Well, if that's reality, I don't know what these numbers are telling us then.
Yeah, definitely does not prove out. And yeah, AI is kind of can be a little bit of a feedback loop and your own preferences and biases. So I think it's great that people want to be active participants in investing and for their retirement and long-term financial success. But again, to your point, what's your process? You don't go to work. If you're an engineer, if you're a home builder, whatever your career choice is, there's a process and a system you have in place to ensure a higher probability of success. Are you doing that on the investment side?
Yeah, so Hello Kitty or Roaring Kitty doesn't count as, I should buy GameStop because this guy in a bandana is in his basement preaching about a company that's on its verge of bankruptcy. But the retail trading army, this one might have bucked the trend, kicked it up high enough to actually collapse some hedge funds along the way. So yeah, I think that's it. And a lot of times we bring this up and people say, hey, I'm on the Nancy Pelosi tracker, which actually apparently isn't the worst decision in the world. The people making the rules can actually outperform over the long term. I don't have any thesis that will continue as well. But you even hear things like, hey, you're talking about all of this and you're giving me the statistics to back it, but there are these anomalies out there in the market, and Warren Buffett is very clearly one of them. And then you have to have this realization to talk to people like, Warren Buffett has an army of analysts. One. Two, Warren Buffett himself sits in his office and reads 6 hours a day. That's number two. Number three, people like Tim Cook, Apple CEO, actually call Warren Buffett and say, here's what our business plan is. Do you want to invest? Like the average retail investor, one, is not calling anyone or getting a call from someone. They're not spending 6 hours a day, and they're not actually reading the underlying balance sheets of businesses to tell whether this is a sustainable company or not. And proof is in the pudding. We're seeing an obnoxious amount of investments go into companies right now that either have zero profits, okay, maybe their expenses are higher than their revenue, but also now that have zero revenue. They have not made a dollar. A company called Oklo is in the market right now with like a $30 billion market cap. It hasn't received a single dollar of revenue yet, which is just lunacy to me, but it's an outside bet on the future of AI needing more energy production, and that's what Oklo is going to fill the void of, apparently. Well, let's hope they can deliver on their promises.
Yeah, without a doubt. It's there's a lot of speculation out in the market right now, and that's another that's an extreme example. But we saw that back in 2022, right? I mean, Goldman Sachs had to invent a non-profitable tech index. It was performing so well, the numbers just screaming. But all of those names that did, I mean, if you go back and look at, I was just looking at a J.P. Morgan report called The Agony and the Ecstasy, and you just look at the names that are on this portfolio. They were the top performers back in 2022. They all suffered what they categorize as catastrophic declines, meaning more than a 50% drop from its peak. Names, and a lot of these companies are still around, right? You look at like Sonos, Etsy's on there, Generac, Moderna, widespread of sectors, different size companies. But all of those individual names suffered monsters losses after a huge run-up, and it really highlights the risk of being in.
Yeah, Peloton and DocuSign are the ones that come off the top of my head that had absolute rocket ships and then came back down to normalcy quickly thereafter. But I think when you talk about the 2020s, we also have to realize we're in a bit of an anomalous environment. And what I mean by that is, if you look at the top 10 names coming into any decade, the top 10 largest companies in the world, and you look back to 1900, there have only been 2 decades where those top 10 names have continued to outperform in the future. And right now, what we have is the top 10 names, and we all can name them. They're the Magnificent Seven stocks, right? They're Apple, Google, Amazon, Meta, Microsoft, Tesla. I think Berkshire Hathaway is a non-tech stock that fits in there, maybe Lilly, something like that. But those names have perpetuated back upwards. And I think the 2020s become this time frame where it seems like stock picking is actually really easy. But historically, those top 10 names have not continued to persistently outperform. In fact, they've dramatically underperformed the market over the next decade. So I don't know, does this continue? What are your thoughts on that?
It's hard to say that it will. I mean, history doesn't always repeat itself, but it definitely rhymes. And just looking at the performance, just to put some numbers on that, the S&P 500 2024, the top 7 holdings contributed more than 50% of the returns of the S&P 500. through Q3 of 2025, the same 7 stocks delivered 41% of the index returns. I mean, those are things that historically are an anomaly, don't happen very often, and it's hard to see that. It may continue for a bit here, but it's hard to see that playing out long term. That we continue to see that type of concentration.
And what's interesting is we're kind of circling back on your comment before where you talked about in 2024 how individual stock picking actually caused underperformance versus the index. And yet last year was the year where you had just wanted to own the biggies because they continued to get bigger and outperform. But clearly something's gone wrong here. And I think that, again, we're beating up on individual stock selection. And at the end of the day, we're not trying to be detrimental and say what you're doing is wrong. But what we're saying is the cards are stacked pretty well against you based on every single underlying metric that you look at. And I think the psychology starts to play into this as well. So we talk about a year, as we rewind back, 2020, we had COVID, and for 45 minutes, the market was up, then it ripped again. So it wasn't that tough of a year to invest. 2021 was an exceptional year to invest. And then 2022 got pretty dark and dangerous. And so you had some of the biggies. Meta drew down 50, 60%. You had NVIDIA draw down something similar to that. And what happens is people just get too close to that oven and they get their hands burnt. And so all of a sudden, like, Nick, we played football. You were quarterback. Like, if you go out there and you throw 3 interceptions in a row, like, at the end of the day, do you continue to chuck the ball around like a madman? No. In all actuality, like, you probably start running the ball. You probably go into a little bit of bunker mode. And you go into that bunker mode at all the wrong time after your hands got absolutely scorched. The stock dropped 60%, even in these big, Teflon type stocks. And then you're out on the other side when it gets that magnificent bounce. That is the only way to conceptualize that stat you gave us earlier, where the S&P 500 was down 19 in 2022 and the average investor is down 39.
Yeah, it's easier to have a short-term memory when you throw an interception. But when it's your personal wealth and your money is on the line, very easy to let your emotions come into play and affect your decision-making on a go-forward basis. So again, I think being diversified, generally speaking, avoiding that emotional connection you have to it, really helps. And I'm guilty of this as much as anybody. Super competitive guy. I like to be right about things, and I hate to lose. So. Yep. When you put yourself in a situation to where you're really tied to that, I think that can definitely affect your go forward performance, having your emotions dragged into things.
Well, how about the other side of it when you're really right? And then all of a sudden you get this swag and this confidence about you. Like, I just threw 3 touchdowns in a row on 3 passes. Like, now let's fire this thing. Let's go all in, right? And you talked about being a guy there. Like, I don't think you intentionally did that. But the reality is, this is a X and a Y chromosome combination that creates this overconfidence, is at least the tendency. Like, women are typically better investors over the long term than men because we get this overconfidence bravado. We start telling people, hey, look what I did in my brokerage account. Bang. I'm just going to continue to recreate this. I'm the world's greatest stock picker. You remember Dave Portnoy? Dave Portnoy was calling out Warren Buffett and saying, Warren Buffett's a moron. Look what I can do. Davey Day Trader is what he was calling himself, which is just awesome. And then he got washed out. Then he got washed out. Let's be clear. He got washed. Yeah. Then he got washed out. Let's be clear in 2022. But let's talk about this now. Let's talk about another risk that comes with picking the right investment, not picking the wrong investments, picking the right investment. So you have NVIDIA stock in your portfolio now, and you bought it, thank God, back in 2018, whatever. And it's up now, X, whatever that number is. Now you face this situation where Uncle Sam is just knocking on your door all the time saying, go ahead and sell it. I dare you. Go ahead and sell it. I dare you. And your tendency is not to want to sell that because it's held in a brokerage account. To be clear, also, most all stock selection, individual stock selection by retail investors happens in a brokerage account. And so all of a sudden now you're in tax jail. And I legitimately mean jail, where you're going to give up 15, 20%. Then you tack Obamacare on top of that. Now it's 18.8 or 23.8% you're giving back to the government. And that's after you made the correct decision and really rode a winner. So now do you trim and pay the piper? Or do you continue to ride this thing and pray to God it doesn't come back down to earth?
Right. I think most people we interact with are doing the latter, right?
Pray.
They're just going to hang on to that and hope and pray performance continues. But to your point, that leads to a lot of other concentration risks, across your entire portfolio. You're really tying your net worth into the performance of an individual or a handful of names. And again, that tax liability, not being unable to navigate that, can make things quite difficult.
And so what people do, we have this anchoring bias in the market, right? So all of a sudden the market goes up and runs up and NVIDIA goes to 250, 300, let's say hypothetically in the future. And then people say, all right, I'm kind of getting close to a point where I'm willing to sell this and pay the piper. And then it pulls back from 300 hypothetically to 275. And now they're anchored to that 300 point. If I could just get back to that 300, I'd be glad to pay the tax and rip my way out of this. But now they have this anchor bias and they're praying 2022 doesn't happen where it drops 70%, right? And so it's this psychological battle that is so hard to overcome. And when we look throughout history, all these big stocks, there's this day of reckoning with all of them over time. We look back. So right now, the largest company in the world is NVIDIA. It's got a $5.4 trillion valuation at its peak. It's not there anymore because it's dropped since. But it was the quote unquote first company to ever have a $5 trillion valuation. Mm-hmm. Well, actually, if you rewind the hands of time, there was a company that was two times the size of NVIDIA's market cap today. It was the Dutch East India Company in 1637. And it had a $10.4 trillion valuation, inflation adjusted today. Nick, do you know what the Dutch East India Company sold?
Tea. Was it tea?
Tulips, my man. They sold tulips. They were the world's best tulip broker, which sounds like bananas to us. And we're like, we've all heard of the tulip mania that took place back then, but it literally drove this company's market cap to $10 trillion in inflation-adjusted numbers today. And we laugh like, tulips, you're an idiot. Like, why ever would someone, think that tulips were going to go to extinction and this one rare bulb was worth $10 million, one bulb, inflation-adjusted today. But then you rewind just 2-3 years ago and you go, wait, what was that NFT thing we were talking about again? What were NFTs, Nick? Explain that.
The digital artwork, I believe, of monkeys was...
smoking cigars.
Yes. That was the fastest way to wealth, I believe. Guaranteed returns.
Yep. No, and it's crazy. But even, okay, let's rewind a little bit further back. And we will get on to mutual funds and ETFs here as well. But let's rewind back a little bit further. And let's look at a powerhouse of a company. The powerhouse of all powerhouses, Apple or NVIDIA of its day, was General Electric. And Nick and I live just north of Albany. A suburb of Albany is called Schenectady, which is right next door to us. That is the headquarters of General Electric. And people don't think of General Electric as an absolute titan today, but General Electric in 2001 was the largest company in the world. And for the next 4 years, it was either number 2 or number 3 largest company in the world. Then what you had, and by the way, let me set some context for the power of General Electric at the time. General Electric was not just a one-trick pony. It had aerospace. It had appliances, it had transportation, it had power. It was this conglomerate monster of a mutual fund, in essence, is how people thought about it, all under one umbrella. General Electric and all that power and might and diversification had a 94% drawdown from 2001 to 2018. Just conceptualize that the largest company in the world, this would be NVIDIA or Apple, having a 94% drawdown over the next decade and a half. That's unconscionable to most people, but that's the reality of what you're facing with individual stock risk. And then take it one step further and say, now you're an employee of that company where they're paying your checks, cutting you a check on a month-to-month basis, and you're sitting in a stock where you're overly concentrated with 80% of your wealth. These tech employees on the West Coast, many of them, especially the senior level, they get paid more than 50% in individual stock of their company. That is the worst company to have a huge concentration in, because not only is your income predicated upon their success, but now your portfolio is as well.
No, yeah, and I think the people who really get that we talk to and work with are folks in like biotech or pharmaceutical space. They're acutely aware of how quickly things can go south there. It's less evident when there's a binary outcome, a drug approved or not. But no, the same risk applies.
Yep. And the risk hasn't really been felt by most of these big tech titans at this point. But we're all starting to see a little bit of kind of chinks in the armor where we start to talk about, okay, does NVIDIA's chips have a 6-year useful life or do they have a 3-year useful life? And should Meta, Amazon, Google, whomever continue to spend this unconscionable $100 billion spend on something that's only going to last for 3 years? And what's this out of China right now where their large language models are neck and neck with our performance with a third of the compute on the back end? So I think there's starting to be some questions that are playing out in the market right now. Meta is down 27% in a drawdown at this current juncture that we speak right now. But at the end of the day, like, listen, we're not saying that money can't be made buying individual stocks. Clearly, concentration has the ability to generate explosive wealth on the upside, but it obviously has the ability to devastate you on the other side. And what happens is as you pick winners over time, your overconfidence starts to pick up and you continue to get more and more confident, pushing more and more chips into the table. And if things do go awry, it can be more catastrophic at that point. So let's fast forward a little bit, or even rewind a little bit, I guess is where we're going to go with this. So there was the advent of something called a mutual fund. Back in 1924 was the first mutual fund launched in the United States. And the strengths that came along with this were unbelievable. And the wealth creation that came along with a mutual fund was the most magnificent thing we've seen in investing at that point. And so now what you're doing is you're taking a basket of stocks or a basket of bonds for that matter, and you're wrapping them up under one umbrella. And maybe you own 50 individual stocks. And the power of it is it was managed by a professional in the space. So it wasn't someone going on ChatGPT of its day back in the, the 1920s. It was someone that was honestly reading underlying 10K reports, starting to get an idea of what their thought on the company's valuations are, and they were deploying individuals' assets for them. And, one of the best mutual funds of all time was the Fidelity Magellan Fund, and it still exists today. And Peter Lynch is an icon in the industry. He ran it from 1977 until 1990. He averaged a 29% annual return, which is just unbelievable. And that was actually before the 90s. The 90s were the dot-com bubble. Imagine if he rode that wave until 99, like his numbers would be 50% per year. But the point of this is the mutual fund stepped in and started to provide a Band-Aid on just folks' ability to buy individual stocks and gunsling on their own. But Nick, let's just talk about, okay, that's the positive to a mutual fund. Let's talk about some of the downside to a mutual fund as well.
Yeah, there's a couple big categories that kind of shift mutual funds into the negative light for us. I think the first one is the management fee. They are expensive ways to get exposure to stocks. Two is you can have extremely high levels of turnover, which can contribute to big capital gains. They're relatively tax inefficient from that perspective. And recently, like over the last 15 years, we've got a performance issue, right? The average, I think it looks like 88% of large cap stock managers have actually underperformed their index over the last 15 years. So you're paying a higher price, you're tax inefficient, and you're not actually beating the benchmark that you're trying to.
Okay, let's talk about what may feel like getting punched directly in the mouth as an investor. And we'll talk about this in the reference of mutual fund taxation. So let me just give you an idea. Let's say you own 4 stocks: NVIDIA, McDonald's, Nike, Google, hypothetically. And inside of a mutual fund, and NVIDIA goes up 2,000%. And the manager then decides, like, I've got too much NVIDIA exposure on the books here, I'm going to sell it down. When that happens, you get a capital gain distribution from NVIDIA, right? And so all of a sudden you get this tax drag where you're getting a distribution, you're going to pay 15% of that, 20% of that to Uncle Sam, and it's going to drag on your overall performance. And that's fine if you're in a mutual fund that's done incredibly well. Let's think about a 2022 experience where the market's down. So all of a sudden you're coming off a year of 2020 and 2021 where stocks do ridiculous upside. And if they're held inside of a mutual fund, all is well and good. And you buy the mutual fund at the end of 2021 and you're seeing all these past returns and going, this is a great underlying investment. And then in 2022, everything goes to hell in a handbasket and stocks come flying back downwards. You continue to hold that mutual fund throughout the year. And at the end of the year, you have a negative performance of, say, 20%, and they kick out a 20% capital gain distribution. Bang. You didn't experience the upside. It was the people that held it before that saw all the upside in the market, but it doesn't matter. You held that baby on November 15th, was the X date, and all of a sudden, whack, you're getting hit over the head with a mutual fund capital gain.
Yeah, that's the quickest way to get really angry phone calls from advisors and their clients, having worked at an asset management firm before. So that's the big risk when you're in one of these strategies that you're not going to get the performance and you get all the downside of the taxes.
Yeah, and we just got Vanguard, and not picking on Vanguard. This is every mutual fund company out there. We just got their report that estimated the capital gains that are going to be distributed in December. And you look at it, and their stuff kicking off 12, 15, 18% capital gains. That is no bueno. And at this point, I think if you're an individual investor, most people have started to shy away from the mutual fund and move into the ETF, which we'll touch on in a second. But what's crazy is the fact that financial advisors, quote unquote professionals, are still stuffing people into mutual funds. Nick, do they not understand the taxation or the fee increase represented of those versus an ETF? Like, what's going on there? Because I can't make sense of that.
That is going to be some type of rev share situation ultimately. And what a lot of people don't know is that higher expense that you're paying for that portfolio manager and firm to run that stock portfolio, a chunk of that is going to that advisor's firm.
Yep. And not picking on folks at big banks, et cetera, but the big banks are the epicenter of the folks that force revenue share. They say, you want your way onto our platform and access to all of our advisors and all their clients, and we've got 12,000 advisors at this firm, you're going to pay the piper. And so, there are firms on the independent. We work at an independent firm which custodies with Charles Schwab. There's no revenue share with Charles Schwab, so there's no vested interest for us to utilize a mutual fund, which we don't do outside of a certain circumstance, which we'll discuss in a minute. And actually, I want to revert back to individual stocks just for 1 second here. I also don't think that financial advisors are any better stock pickers than an individual. And I'll make this kind of analogy. So think about, Nick, you're coming into our firm and we're saying, hey, Nick, we are the world's greatest stock pickers. And we're going to set up a customized portfolio for you, Nick. And you've got 70 underlying holdings because we want to be diversified. We don't want to be crazy and put you in 8 stocks. Okay, Nick, you refer your brother. Your brother comes in. We give him 80 different stocks because it wasn't the same time in the market and therefore the same things weren't advantageous at that point as they were when you came in. Okay. And then your father comes in. You see where I'm going with this. And now all of a sudden you've got 400 clients with 80 holdings in each one of them. All of a sudden you've got 3,200 holdings. And maybe 50% of them have overlap between one and the next. So now you have 1,600 stock holdings that you're trying to keep track of. Like, that is bananas, but that is the lunacy of what individual stock buying is from a financial advisor perspective. You just can't scale it. And by the way, if we're financial advisors and our job is to understand your risk, manage a portfolio, manage taxes, understand when your kids are going to college to make sure they have the right funds appropriate to them as well at that given time. Okay, now we're researching individual companies and going to determine better than someone at one of these large firms where their exclusive job and all of their army of analysts are to analyze stocks and select stocks. Come on. It's just crazy to think you're going to outperform it as an advisor.
Yeah, it's a bit of a stretch. There's just so many moving pieces. And again, all of the challenges that face you as an individual are going to face the advisor in the same way. Concentration risk, navigating the tax situations of those individual stocks. It would be a lot to juggle for sure.
Yeah. Nick, let's think about this. You and I both own NVIDIA, and we have an advisor that's managing our portfolio. You entered 2 years ago. I entered today, or I entered a month ago. My NVIDIA position is actually down. Yours is ridiculously up, and these are in taxable accounts. And the advisor decides, I don't want to own NVIDIA anymore because I don't like the future of AI, whatever. Now they blow out of them. You have a massive capital gains tax bill detrimental to you. I actually have a capital loss that I can book, which might be good for me. But the point of this is, as people come in on different time frames and timelines along the way, even the same stock that seems like the same decision, one binary decision, buy or sell, is not the same because taxes are such a massive decision-making process.
Yeah, without a doubt.
So let's move. So now we've talked about individual stocks. We talked about mutual funds and some of the perils that come along with mutual funds, higher fees, less tax efficiency. Now let's talk about the modern vehicle, which is the ETF, right? So ETFs were launched 30 years ago, SPY was the first ETF that was launched. And at that time, it was absolutely a novel concept. And it took a while for it to catch on. And now everybody knows what an ETF is. But I think understanding the taxation of them and the cost structure of them. So one, we all know that ETFs are just more cost efficient. Typically, you're going to look at a tenth to a half of the cost of a mutual fund to access the same underlying positions. So that's an easy one, just cheaper. The secondarily that I'll mention is the taxation of ETFs. So I'll give you the same example of owning NVIDIA, McDonald's, Google, and Microsoft, whatever. NVIDIA runs to the sun and you decide, hey, I want to trim that position. Or inside of the ETF, they decide they want to trim that position. So long as you continue to hold that ETF, there is no capital gains tax distributed. So whereas a mutual fund, when you sell a winner, is going to kick you out of capital gains tax, an ETF is not. And that is why it is this magnificent wrapper that allows people to tax efficiently move into and out of different sectors of the market within one singular ETF. So that is the huge
Just to
advantage.
add a stat on that, in 2023, 95% of equity mutual funds paid zero capital gains distribution. 2024, 96% did not pay a capital gains. Compare that to mutual funds, where 50 to 70% distributed some type of capital gain.
So rewind back. I think so for ETFs, what was it? What was the statistics for ETFs and then do mutual funds?
Over 95% of ETFs paid zero capital gains distributions in 23 and 24.
Wow.
Looking at the mutual fund side of the stock equation there, over 50 to 70% of the funds in there distributed gains.
So clearly, obviously, capital gains are not a good thing. You pay tax, and there's tax drag on those. So that is a huge, just kind of eye opener. And when you think about mutual funds, or I'm sorry, ETFs, there are different categories that you can buy into. So just talking about stocks, we won't even talk about bonds or anything else. So if you're just talking about stocks, you can buy active or passive. And passive means you're just buying an underlying index like the S&P 500. And then there's different flavors of active that can come in that we'll kind of present here as well. So when you're buying an index, the S&P 500, that can be great and it can be not so great depending on the time frame that you're in. If you bought the S&P 500 over the past 15 years, you're up almost 15% per year. That is incredible, incredible success. To put some bones on that, if you put $100 in 15 years ago, you 5x'd your money in the S&P 500, just buying an underlying index and closing your eyes. Now, that's the rearview mirror. I think going forward, and we talked about the 60-40 portfolio on our last podcast, so go back and listen to that. But I think going forward, what you're going to face is a little bit more of a headwind because what you have is extreme concentration in some of these underlying indexes like the S&P 500, 40% exposure across the top 10 names, which is the most concentrated it's ever been in history. And then when you pop the hood on those top 10 names, what you realize is they're incredibly, incredibly expensive. I'll give you one more statistic on this and then I'll get off my high horse. The last statistic I'll give you is that given the overall price to earnings ratio of the S&P 500, at this starting point at 23 times earning, which is what we are today, you look back at history, we have never created a positive 5-year annualized return from this point going forward. So we're going to have a little bit more headwinds into the future. We aren't coming from 2008, which washed the stock market out and then came from really cheap valuations and rallied on the other side. So Nick, what are you thinking kind of on the index exposure?
Well, on the index exposure, I would agree with you. It's there is massive concentration risk there, and that's why I think layering in some of these other type of ETFs make a lot of sense in this environment in terms of active, right? Which the mutual fund managers we were just dogging on because of their high fees and tax inefficiency have actually just given up on that to a degree, cloned their product, made them an ETF. So of that 12% of mutual fund managers who are able to beat their benchmark over the last 15 years, layering them in specific areas like international equity, that makes a lot of sense. Looking at, there's different sector exposure. There's a variety of different ways you can construct a portfolio with ETFs to give you all the benefits that you're trying to get out of an active portfolio with a lot less of the drawdowns.
Yeah, I can talk to a space that I don't want active exposure. So active can come in a couple different formats. So it can come with the Warren Buffett style, hey, I want to own Geico, I don't want to own Tesla, that kind of underlying mentality. Where I don't want that mentality of someone being a guru and going out and picking individual stocks for me, by the way, that comes with a higher price point, even in ETFs. Typically, you're going to pay 0.6, 0.8% for someone to go out and do that in their firm. I don't want that exposure in something like a large cap growth area of the market, where every active ETF or mutual fund for that matter, when you pop the hood on it, you're going to see NVIDIA, Amazon, Google, Microsoft, Meta, the biggies. And it's like, why are we paying some quote unquote guru 60 basis point, 0.6%, when I could buy that from Vanguard or Schwab or Fidelity or whomever at point where it doesn't make a difference and people want to own exposure to those high techie names. And by the way, we own exposure with our clients there too. We want to cut to the bone and take the cheapest possible route to that. But where we might not want to do that, Nick, to use your point there before, is on the international basis. And I'll even switch the words a little bit and say the global basis. So when you think about a global ETF, inside of a global ETF, you can own US, international stocks all within one. And what I want is a manager that's really well suited to make that decision for us. Hey, when do we want more international exposure versus more developed exposure? Even us as experts in the space, as financial advisors, we might not have quite as good of a context as that as someone at one of these firms that manages $2-3 trillion. And so we'll give them the ability to negotiate more domestically, more internationally. And then the taxation of it is also advantaged as well. If you own two ETFs, one US, one international, and you want to increase your international exposure, and you've owned that US ETF for the past 5 years, now you're selling it down, getting hit with a capital gains tax to rotate overseas. Whereas if that happens inside the confine of that ETF, which, by the way, I think their decision-making process is even better, now you can do it without that tax burden of capital gains tax dragging on your portfolio. So that's where I think that kind of the active within ETF landscape, and then the other kind of ETF landscape active that we like to utilize is something that's called factor-based. And I would call factor-based, or I would name it something differently and just call it rules-based. So instead of going out and buy the index that is overly concentrated in the top 10 names, maybe you want to have a more diversified bucket and you want to have things that have certain characteristics. So it's not a manager making this decision. It's an underlying subset of rules. Maybe I want high quality companies, which would usually be a return on equity metric. Maybe I want low volatility companies. I don't want companies that price is bouncing all under the sun. I want companies that are fair valuation, not crazy priced. And I want them to have positive short and intermediate term price momentum. Guess what? There's an ETF with a name on that. And then that's a lot of what we're doing. And what you've seen is that there's been outperformance, right, Nick, over the long term on the factor-based, rules-based versus just buying the index.
Yeah. And again, these rules-based ETFs are trying to do and replicating what the active managers claim they were trying to do, right? Each portfolio manager had their own different style, a growth at a reasonable price, high momentum manager, whatever it was. But again, you're paying a much higher fee for that, and you weren't getting the tax benefits and the capital gains treatment. And now you can implement those into the core of your portfolio to make sure that you're staying diversified and that your portfolio represents, actually what you're trying to accomplish with that sleeve.
So important today with the concentration risk in the market. And even over the long term, over the past 30 years, factor-based ETFs have outperformed the market by 1 to 3% per year. So it's been a great underlying investment strategy. So when it comes to owning mutual funds, I do think there is a spot in the portfolio where they make sense. And I think that spot in the portfolio where it makes sense is something that is an off-the-run type asset like farmland. We talked about farmland on our last podcast. And the thing about farmland is it's not a liquid underlying asset. So Nick, like if you and I buy an ETF and 20,000 other shareholders buy an ETF that's a farmland ETF, what's the problem with that?
Well, the problem is that the liquidity of the underlying security does not match the wrapper that it's in, right?
Yep.
And that's, we see that across the board. We've seen a kind of an explosion, if you will, of private credit ETFs from some firms we like. That's not their core competency. They're trying to participate in the growth of this alternative asset market, but that's a total misalignment in terms of how that ETF is going to trade and how the underlying securities will trade. So that's a big key, and where I think mutual funds can and do have a place in a portfolio.
Yeah, so the mutual fund that we like to utilize, which is the only place we utilize mutual funds, is what's called an interval fund. An interval fund, the way it works is when you purchase the interval fund, you can purchase at any day of the year. You can only sell out on one stated date in a quarter. So back to my farmland example for a minute here. When you put your money in and 20,000 other shareholders do, if it was an ETF, half the people could hit the exit button tomorrow. And the manager's now got 100,000 acres of farmland that they're trying to fire sale back on the market to get to you. And that's the function of an ETF that allows investors to come and go as they please. Inside of a mutual fund and an interval fund specifically, what it does is limit that exit ability. So it allows the manager to go out and buy that 100,000 acres of farmland without the thought of, hey, I might have to fire sale this. It just doesn't work. So when you're buying a less liquid asset, you want a less liquid vehicle in order to get that access point to that asset. So there's no fire sale type proposition out in the market.
And you can see that just even in publicly listed REITs, right? Like real estate, it's just not that liquid of an asset on its own. When you put an equity wrapper, those things can be all over the place when really the underlying value of the property that they own isn't fluctuating that much.
Correct. No doubt about it. So in wrapping this, Nick, I think the way we look at this, and I don't want to put words in your mouth, so feel free to disagree with me. I think stock exposure individually is okay. If that is your druthers and you want to take some stock exposure, limit it. Maybe 5% of the portfolio or something like that. I think where we want to lean in is we want to lean in on ETFs. The cost efficiency, the tax efficiency of them are just unparalleled with any other vehicle in the industry. And the old school mutual fund, I will say, is dead. I think that the ETF has just taken its place with more cost efficient, more tax efficient nature. But the one area of the market we'll continue to access until something else comes out that's more efficient is the interval fund of mutual funds, to access the areas of the market that are just less liquid, whether it be real estate, whether it be farmland, whether it be private equity, private credit, all of those underlying things. They need that limited liquidity to gate the fire sale opportunity in the market when you're trying to sell something that's just outright not liquid. Quick ask, if you're enjoying the show, hit the follow and drop a rating. It helps more folks find our podcast. Thanks so much.
Information discussed in this video is for educational purposes only and should not be considered investment, tax, or financial advice. Investing involves risk, including possible loss of principal. Always consult a qualified financial professional before making any investment decisions. Past performance is not indicative of future results.